but the government is contributing. And that's that win-win that I talk about in my book, The Win-Win Wealth Strategy, is that it's the win-win between the government and the taxpayer. Everybody's putting in money. The economy wins.
My name is Mike Mauceli, and this is the Energy Show with REI Energy, where we're energizing your investments and maximizing your tax deductions. Today, we're going to talk about oil's unique tax advantages, and you're going to discover how investors reduce their tax with oil and gas unique tax opportunities. Our guest today is Tom Wheelwright. Tom is a friend and a tax expert and founder and CEO of Wealthability. Tom also hosts a podcast, The Wealthability Show with Tom Wheelwright. Tom is a best-selling author. His first book, Tax-Free Wealth, and the second book, The Win-Win Wealth Strategy, 7 Investments the Government Will Pay You to Make. Great to have you on the show today, Tom.
Always a pleasure to be with you, Mike. I love oil and gas.
Yeah, and I've obviously appreciate the chapter you wrote for me in my book that's coming out. Hopefully, it's going to be coming out here in this fourth quarter. So, I really appreciate that.
Yeah, of course. No, happy to do that.
So anyway, let's talk a little bit about oil and gas and investing and how taxes really, kind of incorporate into not only oil and gas, but other investments. But, one of the biggest, of course, tax deductions out there is for the oil and gas industry. So if you could talk a little bit about the different types of deductions that investors or people can take, we can kind of start there.
Yeah, one way to look at it is a lot of people talk about tax efficient investing, which means that you're not going to pay tax on the income that you earn on your investment. And those are things like annuities and 401ks and municipal bonds. But what oil and gas is, it's actually tax effective, meaning that it actually reduces the taxes that you earn other places from the taxes that you would have on income earned other places, even your employment income. And that's unique to oil. So back in the day, in the 1986 Act, when they put in the passive loss rules, because of course, for those of you who don't know, most passive investment is subject to these passive loss rules. And basically what it says is that your passive losses can only offset passive income. Now, that doesn't mean that they're not worthwhile. It just means that you don't get the deduction immediately unless you have passive income. There's only one exception to that rule. And that exception is oil and gas. If you invest in a drilling program, cannot be a stock, of course, but if you invest directly in a drilling program and you invest and take the risk, meaning that you're not a limited liability company, you're not a limited partner, you are at risks, subject to insurance, of course, which I'm sure you'll talk about. But if you're at risk, then even though you're completely passive in the activity, you have no time into the activity other than the investment you make, you still get the full benefit of the deductions. And of course, the deductions, as you know, Mike, are significant. Interestingly enough, I find that most syndications actually take that into account. And I get a little disappointed when I see that, frankly. In other words, they treat it as a return on your investment. What it really is a reduction of your investment. It's not a return on your investment. It's a reduction of your investment. So for example, intangible drilling costs, which is, I'll let you explain that, but basically everything other than the equipment is, that's the costs of drilling the well. So those costs, which some typically I think are 70 to 80% from what I've seen of the investment, those costs create a loss right off the bat. And you get those, you can even get those before the drilling starts, which is another unusual aspect of oil and gas. But the issue is that let's say that you get that tax benefit. Well, if you're in a 40% bracket, and eventually, by the way, you'll not just get the 80%, you'll get the rest of it too, because you'll get the equipment as a deduction with depreciation. So let's say that you put in $100,000 and you get a $40,000, $100,000 loss, basically,
Right.
which in a 40% bracket gives you 40% less money that you put in. So the government puts in that case, 60%, and you put in 40%. It's not a return on your investment. This is, it is a return of your investment, but is not a return on your investment. So all it means is that the government's decided that the government will put in a portion of it, of the capital, and you put in the other portion, and that's the way you reduce your risk, because now you're not risking the full 100,000. In that case I just brought up, you'd be risking $60,000. You're still risking $60,000, and that's one thing that I explain to investors all the time is they say, well, I'm going to get a tax deduction for it, so therefore it doesn't matter if it makes money. Yeah, of course it matters if it makes money, because your tax rate at maximum is 40, California 50%. So you're still putting in a good portion of the money, but the government is contributing. And that's that win-win that I talk about in my book, The Win-Win Wealth Strategy, is that it's the win-win between the government and the taxpayer. Everybody's putting in money. The economy wins. We have, we're producing oil for the economy. So it's very much a winning strategy for both sides.
That sounds great. So let's unpack that a little bit. So as far as, for example, in our types of partnerships, investors, they can come into our drilling partnerships either as a limited partner or a general partner. And of course, as a limited partner, do they still get the same tax deductions as you would if you were a general, or
they get the same deductions. It's just not the same timing of when they just don't benefit from it in the same time period. So if they have passive income, then yes, they get exactly the same. But if they don't have passive income, now let's talk about passive income. Passive income comes from income from a business in which you don't spend much time at it. Okay. And so, for example, if you had an investment in a real estate development and you didn't do any of the work, that would be passive. And any income from that, any rental income that was otherwise taxable, would be passive income. Or if you had an investment in somebody else's business and it was a pass-through entity, then you invested in that, you would have passive income. However, very few people have passive income because most of their income comes from wages, or it comes from the business that they're actively involved in. And so the challenge for people is if they invest in an oil program as a limited partner, they're eventually going to get that loss. Okay. So first of all, they will get it to offset any income from the property. But second of all, they'd get it at the time that the property was sold. So those are the two times they would get it, or when they have other passive income. So it just potentially significantly delays. Now, if they're investing if they're investing a different way, I've never figured out why you would do that. But let's say you invested through your IRA or your 401k, which is legal, you can do it. Then being a limited partner would be fine because you're not going to get the tax benefit anyway. So I don't understand why people would invest as a limited partner. It makes no sense to me.
Yeah, probably 97% of our investors invest as a general partner. But as you were saying, oil and gas, does that throw off passive income?
It does if you were passive when you went in. So this is another unique aspect of this. The fact that, so I know most drillers, and I believe you included, once it starts producing income, you turn it into you turn investors into a limited partnership interest. And that is a very common practice. And frankly, I highly recommend that to anybody who's invested in oil and gas. Make sure that that's what happens, because what you don't want is you don't want to still be on the hook legally when you have no tax benefit for being on the hook legally. Even though you're now a limited partner, though, that doesn't change the fact that it's still treated as active income. So you don't get to convert active losses and passive income from the same deal. That doesn't work. Okay. So if you take the deduction up front and you're not a passive investor, then when the income comes in, it's not passive. But if you were a limited partner going in, and so you have passive losses up front, you would also have passive income when the program starts throwing off taxable income.
Okay, so I understand. So as far as, the passive income part of it, now from time to time, I always get investors say, well, why can't I invest through a limited liability company? Isn't that a pass-through entity? And don't I get the protection as being a general partner?
And yes, you do, but you don't get the tax benefits because now you're passive, because the
Oh,
rule's very specific. Remember, the general rule is if you don't spend the time and if you're not actively involved in the business, you don't, it's passive, right? That's the general rule. So this is what people misunderstand about tax law. You have general rules and then you have exceptions to the rules. When you have an exception, you have to very specifically meet that exception. And you have to meet every aspect of that exception. So in the oil and gas, for the passive loss rules, the exception is you are fully at risk. If you are investing through a limited liability company, you've just taken your risk away. So therefore, you don't get to be treated as an active investor. You're now a passive investor. So a limited liability company investing through your own limited liability company has the same effect as investing as a limited partner.
Now, what about if you invest through a trust?
Well, so trusts have their own rules, and it would depend on the type of a trust. So typically, we have fundamentally three types of trusts. We have a grantor trust, we have a simple trust, and we have a complex trust. These are what they're called for tax purposes. Okay, I'm not talking about the legal types of trusts. I'm talking about the tax types of trusts. There's really primarily three types of trusts: grantor trust, a simple trust, and a complex trust. A grantor trust is invisible and it has no asset protection. It does not protect you at all. So therefore, if you can have your oil through your living trust, that would not affect your deduction, would not have any impact because it's actually completely ignored for tax purposes. It doesn't protect your assets. The sole purpose of a living trust or a family trust is to avoid probate when you die, make the transfer of assets easy from the person who died to the people who inherit the assets. So that type of a trust, no impact. But a simple trust and a complex trust, so a simple trust is one where all the income is distributed every year, and a complex trust is one where the income may or may not be distributed. In those two cases, now the trust is presumably it's not a grantor trust. If you're protected, I think you're going to have an issue because if it's a simple trust, those losses would pass through to you. Okay. Because in a simple trust, it's all the income is passing through to you. Actually, I take that back. The challenge is that you have an aspect in trust. You've added a level of complexity here, Michael. You have an aspect of trust which is unique from an accounting standpoint. The trust has two things. It has income and it has corpus. And corpus is basically the capital in the trust. Okay. I would have to look at this, Mike. Whether intangible drilling costs go against corpus or go against income. The depletion is going to go against income, but the intangible drilling costs, I'm not entirely sure that they would not go against corpus. So assuming they don't, let's assume that they don't, because they should pass through its ordinary deductions. Then presumably what would happen is if you are protected from an asset protection standpoint, I think you still have an issue. Okay.
Well, the only reason I ask it is that, from time to time, I have investors that ask those questions to me or partners, well, can I invest through a trust and will I still be protected? And do I get those, still get those deductions?
I would say most of the time when they're asking that question, they're asking a question when they have a living trust. Most of the time, because you do want your assets in a living trust. I'm not an attorney, but just as a general business advisor, I'll say, I mean, I love having, I think everybody should have a living trust, because what it does is, when somebody dies, that's hard for the people who are still around, right? I mean, it's a very emotional event. And so what you don't want is, you don't want to have financial complexities added on there. And one way to completely eliminate some of the financial complexities is to put all of your assets into a living trust, because at that point, remember what probate is. Probate is the mechanism that the state uses to retitle the assets from the person who died, the decedent, to their heirs. It's just retitling the assets. That's all probate is. Well, if you put the title of the assets into a living trust, there's nothing to retitle, because it's in the trust, and the trust dictates how the assets, who gets the assets and what happens to them. Your will does not. Your trust dictates that. I love living trusts. I just think I've seen them work. They make a huge difference in people's lives when a loved one dies. And so I highly recommend don't just have to set up the trust, though. You actually have to put the assets in there. So for example, Mike, if I were investing in one of your programs, I would invest through my living trust. Absolutely. Because there's no tax consequences to it, positive or negative. There's no tax consequences, but it means that should I pass away, automatically, there's no probate, because now those assets, the income from that oil production, just goes to my heirs automatically. Nobody has to do anything. It's already set up in the trust.
I see. So from time to time, I also have people that want to invest through joint tenants in common with right of survivorship. Now, how has that impacted the tax? I mean, I don't really want to get into a lot of the legal issues about whether it protects you or not, but I mean, does the tax still pass through?
Yes. So joint tenancy is pretty much the standard. Joint tenancy with right of survivorship. I mean, when I bought my first house, well, I asked the real estate agent and asked the mortgage broker, how do I title this? And they said, well, joint tenants with right of survivorship. That's what you always do. And for personal assets, that's fine if you're not going to have a trust. Okay. Now, still, trust is better than joint tenancy, but joint tenancy is fine because it has no tax impact. Joint tenancy, assuming that you're joint tenants with your spouse, okay, and not somebody else. Remember, you could be joint tenants with anybody.
Oh, really?
Yeah, it doesn't have to be spouse. You could be a joint tenant with right of survivorship with your daughter or with your son. And so if it's with your spouse, it's going to have zero impact because you're going to file a joint return and you're basically a single taxpayer, and all those losses will pass through. So I don't have any issue with that. I still prefer doing it through the family trust.
So getting back to the liability, I guess, when you invest as a general partner or through one of these entities that you really don't have of course, in our programs, we carry insurance that covers all of our non-operators. And then once all the tax deductions are taken, then everyone is converted to a limited partnership as far as that. But you're saying that the income, even though you convert after being an active partner, your income is still active?
It is. It's still active. Now, it's still active for the passive loss rules. However, it is not subject to self-employment tax, which is a very important point. And it's actually another reason why you convert to limited partnership, because the rules that are for the passive activity rules that's not the same tax provision as the self-employment taxes. Remember, business income, if you're a general partner, business income is subject to self-employment tax. Well, what's interesting here is that those losses, when they pass through to you as a general partner, they will offset other business income and other self-employment income. So you not only get the income tax benefit, but you'd get a self-employment tax benefit if, say, for example, you had Schedule C income, or you were a general partner in another partnership. Okay. So it would offset your self-employment tax. But when you convert to a limited partner, all of a sudden you're a limited partner. So therefore it's not subject to self-employment tax. And that's a basic 15.3% rate. So that's a huge tax benefit.
I see. And so is the income being thrown off from oil and gas? Is that ordinary income?
It is. It's ordinary income, obviously subject to the 15% depletion allowance, but it is ordinary income. It's just regular ordinary income. And it's active income. Like I said, it's not subject to it's not passive income. It's active income. But it is business income. Now, that's actually another important point that most people don't recognize. And it's not important for most people.
So anyway, if we could just run over kind of quickly just a theoretical investment in oil and gas. So for example, in a syndication, an investor goes into a syndication and say they've got an upfront cost for the syndication cost of say 12 to 15, say 15%. And so an investor can't write that off, right? I mean, that is a cost.
Right. So the cost of syndicating it is not deductible. Actually, it's never deductible.
Okay. So then you have lease costs, right? Say you've acquired some leases, you're going to drill some wells on it, and now you have a lease cost sitting out there. So the intangible drilling cost, you can write all of that off in the year that the wells are drilled. But the lease cost, how do you address that?
That actually comes through as depletion. So that is the depletion. That's what you're getting depletion for. That's part of the depletion allowance is the lease cost.
So you can actually take that over time, right, as you deplete the assets.
You can, though you're not really going to get it. And the reason is because you get 15% as depletion, whether you actually have costs or not. So it's called cost depletion. Okay.
Yeah.
Versus percentage depletion. Cost depletion is, that cost of the lease, right? You're actually depleting the actual cost of acquiring the oil, right? That's what the lease is. The lease is a cost of acquiring the oil. Now the royalties, that's different. So the royalties, that comes off the top. You get to deduct those royalties. Obviously you're paying anywhere from 12.5% to 25%. I think sometimes even more, right? Right, Mike? Right. So those royalties, that's not your income. That isn't even that's not your income at all. Upfront costs in that lease, those would be part of your cost depletion. And effectively anymore, it used to have a benefit because we used to have alternative minimum tax, but we don't now. That could come back, by the way, the end of 2025. And then it would be an issue again. But for now, that's not an issue because the cost depletion and the percentage depletion, effectively, the cost depletion is never going to be more than your percentage depletion.
And then say on your tangibles, right? All of your equipment, your basically all the tangible items. Now, I know under the Jobs Act, you can take a portion of that up front right now, right?
Right. So right now that's called bonus depreciation, and that's 60% in 2024. It goes down to 40% in 2025 and 20% in 2026. There is a lot of discussion in Congress right now about bringing it back to 100%, which it was through 2022. We'll see. We'll see what happens there. But it's not that you get 60%, that's it. You get 60% now, plus the rest of it over the life of the equipment, which typically is anywhere from 5 to 7 years.
I see. And then say you've owned this property and, you've gotten your money back and now it comes time to divest of it. And say you put in just a round number, $100,000 and I got $187,000 back. I mean, so you have to pay recapture is that on the 87,000 or what you just took the deductions on?
let's talk about recapture for a minute, Mike. So
Okay.
let's say that you sell the investment. Okay. Now, what happens to that intangible drilling cost? Remember that intangible drilling cost and the depreciation reduced your basis in the investment. And so your income is going to be everything that you get more than your basis. So for example, if you got $187,000, then let's say that you'd put in 100,000, but you'd actually written off $87,000. Let's make it easy. Okay. You wrote off 87,000 between intangible drilling costs and depreciation. So what you're going to have is that $87, that 87,000 is going to be ordinary income. That's called recapture. The rest of it, the $100,000, is going to be capital gain because you sold a capital asset. But anything that you got an ordinary deduction for, you have to pick up in ordinary income.
I see.
One more piece on this. Let's say you're passive. Okay. Mm-hmm. So you didn't get your passive losses. This is actually a benefit to you because what happens is that $100,000 that's capital gain is actually not technically called capital gain. It's taxed at capital gains rates, but it's called 1231 gain. And a 1231 gain, the importance of that is it's passive. So if you were passive in the beginning, that $100,000 plus the $87,000, they're all passive, which means that you'd have $187,000 of passive income and you'd be able to use any other passive losses. You'd free up passive losses, say from a real estate deal. Mm-hmm. So you'd be able to free up those passive losses, but those passive losses are all ordinary deduction. So I'm going to run the math here for you. Let's say that your capital gains are taxed at 20%. Well, your ordinary loss is a benefit at 40%. So that gain, you actually could end up with a net tax decrease by selling the property.
Huh. I didn't realize that.
Yeah. So it's very important from the developer standpoint that they're recording that gain properly, because sometimes I see them record it as capital gain. They must record it as 1231 gain. You'll still get capital gains taxes on it, but it's 1231 gain because capital gain is not passive income. It's called portfolio income. But 1231 gain is passive income. So if you invest as a limited partner, and now you've gone through this scenario where you took you have $87,000 of passive losses. They're just sitting out there. You never got them. You've got $187,000 of gain. So the $87,000 of ordinary income is going to be offset by your $87,000 of losses, right? Because now you're just a wash. Okay, now we've got $100,000 of capital of 1231 gain taxed at capital gains rates. But let's say that you got $150,000 of passive losses from other deals that you've been in. Well, $100,000 of that frees up. That $100,000 loss offsets your wage income at 40%. So you get $40,000 of tax benefit, but you're only paying $20,000 of capital gains tax. So you're actually getting a net tax decrease by having a gain.
Wow.
It's a very odd situation, but it is an odd situation that happens when you have passive losses and passive capital gain.
So what you're saying is investors that have real estate investments and different types of investments, I mean, the recapture may be offset by some of those other losses.
Correct. And it may actually be good. It may actually more than offset. So you may actually end up in it. So I have a client that last year had some sales. It was real estate. And they had significant gains, like several $1 million of gain. Their taxes went down.
Wow.
As a result. So this is where a good tax advisor is going to be particularly important to you, because I will tell you that a lot of tax advisors do not know this rule and they do not apply it properly. And you also need to pay attention to your K1. Your K1 is what you get from the developer, the syndicator for your investment every year. Shows your taxable income or your taxable loss. make sure that those are being done correctly, because not everybody does them. Mike, you guys have always done them really nicely. You've got really good people doing them. But I've seen a number of syndicators, whether real estate, oil and gas, others, that do not do them correctly, and it can have a huge impact on the investor's tax liability.
And it's pretty important to work with CPAs that work with you, because obviously they have your knowledge and they're knowledgeable, and y'all, I mean, I find that a lot when I talk to people, that their CPAs really don't understand, oil and
Correct.
gas investments, especially if they live in a state that's not an oil producing state, right?
Right. I'm probably the only oil and gas guy in Arizona.
Well, Tom, it was great to have you on today, and man, I got to get you back again. I didn't even get into the mineral package that we offer minerals now, and I want to talk a little bit about that. But
Right. Well,
anyway, can you tell our listeners how to follow you?
Yeah, absolutely. If you're looking for an advisor, actually go to tfwadvisors.us. And this is our franchise of CPA based tax advisors. If you are looking for education, go to wealthability.com.
All right, Tom, great. Thanks to have you on.
This podcast is a presentation of Rich Dad Media Network.